you'll get a lot more attention from me, so watch out. Well, welcome everyone. We've had a great array of presentations already, and this is certainly a hot topic on private credit and property. There's been no shortage of attention from it in the marketplace. It has been, private credit particularly, has been delivering some very strong risk-adjusted returns over the last few years, and in the recent volatility, it's certainly really highlighting its appeal for its defensiveness, which has been already mentioned many times today. But with the growth comes scrutiny. And with that, also investors need to look at, there's a lot of new entrants on the marketplace. Where are you truly getting that defensiveness, and what are the protections being put on place on your investment? So we're going to kick off. I'm just going to hand over for each panelist to introduce themselves. I've asked them not to hold back, not to be polite. We want to get into the nitty-gritty.
Hi, Andrew Beaumont, Director at Vest Capital.
Anton Phillips, CFO of DelayPay and Bridgemill Ventures.
Hi, Angelo Borrello from Acure Asset Management.
Daniel Erez from Pindara Partners.
Campbell, Newman, Arcana Capital.
What a panel. So across the spectrum, we've got people in both debt and equity, in property, agriculture, you name it. So there'll be a lot of different opinions today. I think the first thing I want to dive into is yield. That's what we're here for, right? But where is the risk? And how do we manage that risk to make sure that you are all getting the right risk to return? I'm going to jump in with Anton. Your model is all based on extending working capital to farmers. And that is an industry that is exposed to commodity prices, climate change. How do you manage that risk to make sure that your investors get a reliable yield?
Thank you. So, albeit that we are exposed to commodity risk, I guess by providing the sort of funding at the back end, we sort of reduce that. And we do that by taking a sort of caveat on property. So we take a position on farmland, not just fertiliser. The outcome of fertiliser is it gets put on the ground, and how we're going to recover that. So it doesn't work. We do get the grain sale at the end, but land out the front. In addition to that, we sort of look at ourselves as more of a trader. So rather than just providing funding, we're trading a good in, which means that we can sort of back solve some of that with an insurance product. So in essence, we've got 90% of our entire portfolio covered by a QBE insurance product. So if they trade default, we can lodge that in and take a claim. And then, the margin's at risk there. So we have to work with property to get that.
Thank you. That's quite sophisticated. Daniel, once you're a credit investor, you never go back. I like that. But you are in an interesting position. You do preferred equity, you do tactical credit. Would like to understand, what do people misunderstand about tactical credit and second mortgages? And what advice would you give them?
Sure. Yeah. What do they misunderstand? I would say that I guess the word mezzanine debt means more to people coming out of the GFC, and there were obviously a lot of losses that occurred post-GFC across the capital structure. And like most traumatic events in your life, most people anchor to those traumatic events. So when they hear that word again, they think back to those events. But the reality of today is that, and I guess this goes back to our story of when we started Pindara Partners, we'd sold a business, we'd made some money investing, and we thought, where is the best place for our capital? Where are we going to invest? And that's how we embarked on that journey to get to tactical credit, where in our view, we could generate equity-like returns from credit protections. Now, that relies on a few things. One, having the expertise and the background to underwrite that construction or development-related risk, but also recognising that when you invest in a project actually matters more often than where you are in the capital structure. For example, on one end, you've got unzoned land, which is very hard to finance, if at all. On the other hand, you have a completed product, which a bank will lend up to 90-95%. So clearly there's a difference in the risk, and you can move up the risk curve as you get closer to the point of completion. So our takeaway was that if you get closer to the point of completion, you can actually invest higher up the capital structure, get paid appropriately, or in some cases mispriced in your favour, and we think, you know, that's really interesting, especially coming into this interest rate environment.
In my fund, we actually do a lot of the before and after construction, and I actually agree with you 100% on that. We see that every day in what we do.
Right.
And Campbell, thanks for joining us as well. Your model is quite different. You give investors direct property ownership rather than in a diversified pooled fund. That's quite a deliberate choice. Why have you chosen that model, and what do you give up in diversification for having that control?
Well, it's really very much driven by our investors, because we actually have a particular slice of, if I can call it that, of investors who are very sophisticated people themselves. Many of them could afford to buy some of the things that we buy, whether they be shopping centres or fuel stations, office assets, in their own right. But they've worked out a few things. They don't like the hassle of managing them. It doesn't matter if you employ a top end of town property manager to do that, you're still going to be bothered. There's still decisions to be made. But they also have worked out that they would like to be diversified through participation in a whole range of investments. So what we essentially are doing is we've got a sausage machine, which is, or a conveyor belt of these opportunities that are popping out in front of investors. And it might be, you know, this quarter it might be an office, say in Brisbane, or next quarter it might be a car showroom in Darwin, and they go, well, I don't like office buildings, but I love car showrooms tenanted by eagers, and so they pick and choose. And you know, what we say to people is ideally try and participate in a number of the opportunities. But again, it's about their choice, and they're going, well, I don't like a diversified fund because it's opaque, I can't see into it, whereas I'm going to back myself looking at the IM, the information memorandum I've got from Arcana. I'm going to sort of get into and see if I really like that investment opportunity. So it's driven by investors.
Yep, I think that's very true. Some investors want to trust the management, go in a diversified pool, whereas some like to really look at the asset themselves. That makes perfect sense to me. Angelo, similarly, you're also invested across a diverse range of different property type investments. Where do you see the biggest opportunity, and what segments do you see declining?
Yeah, thanks. Well, like Campbell, we do play in yield-focused property investments and right across Australia, and we are agnostic on sector. So we tend to try and focus on counter-cyclical opportunities, which does involve convincing investors to follow us with our money. I've probably been around too long because I've got too much grey hair, and I've seen cycles change across all sectors. You know, so right at the moment, you know, we kind of like office because no one else likes office. So from that point of view, it's been down for some time. We've gone through COVID. We've had the work from home experience. I think there is a focus of corporations getting people back to work. So I do think there's probably some good times coming for the office market. We've played strongly in industrial in the 2013, 2015, we bought about 100 million worth of industrial, and we've now sold all that. We still like industrial, however, the risk return probably isn't there for our investors to chase that asset class just yet. But we are watching it closely. It is softening a little bit, so as it gets more attractive, we might jump back in at some point. Geographically, it's interesting. I mean, we see, Melbourne suffering a lot post-COVID. The taxes that have been imposed on property owners is substantial. We've sold all our assets in Melbourne, and we're waiting to see whether there's an opportunity to go back at some point once that flushes out a little bit more. But that gives a bit of an idea. I mean, retail is very popular at the moment with investors. I think retail is a very active asset class, so probably has more risk in some areas than people think. We also own a few shopping centres, so we do like to position ourselves across the country.
But yeah, I certainly think Melbourne will have its boom again. And I'll be returning to the office if there's some good drinks there from earlier. I'm saving on plastic bottles. Andrew, I'd like to finish this first theme on yield with you. Private credit is often touted as real assets, low volatility, equity-like returns. What's to lose? But I'd like to hear from you around what's the blind spot that investors might not be aware of, and what should they really be looking for in their review for red flags?
I think the blind spot is risk. As yields compress with interest rates naturally falling through this cycle, and more competition from private credit operators coming into the market, which is providing more liquidity and dropping yields, I think there may be a tendency for fund managers to put more risk into their investment products, and I think that's a mistake. We are very clear about what our investment thesis is. Job number one, protect capital. That's it. Job number two, to generate yield after that. And if we can still generate more than 10% returns to investors while sticking to our very clear priorities of what our investment thesis is of protecting capital first, we believe that's the right way to do it.
Okay, great. That's actually a really good segue into the next theme that I want to explore. Each of the gentlemen here have built very successful businesses, have scaled them up, but I'm keen to get into how do you scale without blowing up? When you get a lot of investor demand in, there's a lot of capital and private credit, there's the temptation to chase the deals. When do you say no, and how do you maintain discipline while trying to get money out the door is what I want to get into. So Anton, I'm going to start with you. You've just had a big influx. You've just recently raised $16 million, so congratulations on that. How do you manage that pressure to get the money out the door but keeping the quality up?
It can be hard because there are the pressures of paying for money that is sort of sitting latent. So we're very lucky. We managed to deploy a lot of capital when commodity prices were shooting through the roof. Livestock had doubled in price week in, week out for a long time. But we were very sort of conservative in how we put that money out and made sure that we were tied up on the back end because we knew at some point that's going to go down. And it did big time. And we saw a lot of pain in the market from some of our competitors who were solely sort of isolated in livestock. And Stockco was a big business that grew very, very quickly. And a lot of people tried to follow them, I think. And so we sort of looked at it and said, well, let's make sure that we diversify across everything. We don't just want to be in cattle. We want to be in sheep. We want to be in fertilizer. We want to see it in water. We want to be in land. And that sort of helps with that, just to make sure the money comes back. The other side is we're a very short duration as well. So we only lend out for 180 days. So we have a good pathway to money back in the door. And it's very seasonal farming. It rains a couple months a year. They get paid once or twice a year unless they're a dairy. And so we can manage that. For us, it is definitely we need to get more money out. We charge about 30% per annum effective rate, and so it's not cheap. But we just manage that with a team of 3 and say, well, let's just sit slow, pick the deals that we like, and not sort of go outside of our barriers. If we have to give money back, we will, and that's the priority. So
it also helps to have a cash yield account that allows you to bring money in and out and still get not 0% on your money, undeployed money. I'd like to go a little analogy. Being a private credit fund manager is a little bit like when you buy a boat. Your happiest days when you get the money out the door, and your second happiest days when you get it back, like when you buy and sell a boat. Daniel, I'm keen to get into, from your perspective, you've scaled before. You've sold to London giant ICG. How does the learnings from that shape what you're doing now?
So much, Francis. So much. For us, it starts with first principles. Make good investments, generate returns, return capital, build a great business.
Easier said than done.
Yeah, it's as simple as that. That's all you need to do. people are asking us this time, oh, are you going to build this to sell again and so on? And honestly, having done it now, we're not interested in selling. I think for us, we just want to make great investments, invest our own capital. We're now at a point where, because of our network and relationships, we're out originating our own capital base and starting to think, we've got a couple of families that invest with us, but maybe it's time to start, expanding that out. And, I've been friends with Steve for a while now. Once he hears something like that, you end up at a function like this. That's very different to building a business to sell. And we've seen a number of fund managers that have, onboarded AUM in our view, perhaps for the sake of, AUM growth. And that's not always aligned to the interests of investors. In fact, it's generally not aligned to the interests of investors. So I think as an investor, if you can get to know the manager that you're working with and try and determine their motivations and how they approach what they're doing, are they investing themselves? Why are they doing what they're doing? That can help somewhat in mitigate that risk of perhaps, a manager behaving in a way that's not aligned with yours.
Yeah, certainly co-investment offers true skin in the game. Your manager has a lot to lose as well then. At our fund, we've got a first loss position for management, so that gives an extra level of protection that if we're putting the product forward, we want to stand behind it.
Yeah, because you lose first, right?
Absolutely.
Yeah, that's great.
And Campbell, you've closed a string of deals lately, so well done on that. Interested in what's the red flag that at the last hour might make you walk away?
Oh, gee, there's any number of things that could sort of trigger a deal falling apart and you're pulling out of it. But I suppose just to go back to perhaps the earlier part, for us, our process is really, it's one of consensus. So there's three managing directors within the business, Christina, Peter, and Cam, and if we're going to buy something after we go through our process, it has to be a consensus decision. It's not going to be a vote. Everybody's got to be green lighting it. And the beauty of what we've got is that we've got quite different personalities. And, there's for example, a great deal of conservatism in Peter. And if it can go wrong, Peter believes it will go wrong. Volcanic eruptions and tsunamis seem to be in his mind as well. So, but seriously, the dynamic is what I think is important to us. We always invest alongside our investors, so we've got real hurt money in there. And preservation of capital is our number one consideration. Back in the early stages, we had some spectacular deals. We also had a bad deal as well, which we've continued to have to work through, and we don't take fees on that particular deal, but ultimately we're going to sort of give our investors their money back. So that experience, the good and the bad experiences, sort of factor in everything we do. But when you're doing a property deal, you just have to be exhaustive in looking at, there's the location, the market, that you're going into. There's the fabric of the building itself. There's the tenant and their prospects. There's legal due diligence. All those things have to come through. Occasionally you'll make commercial decisions where you go, well, we've just found that the air conditioning system's going to blow up. It's going to cost $500,000 to fix. Do we still want to proceed? Well, we've always factored in CapEx for things like that. But if it's bad enough, you might pull the pin at that stage. So there's lots of things that can kill a deal, and you do have to be prepared to walk away, and we have and will.
The last minute Google search sometimes reveals a lot that doesn't come up in the due diligence. You find out there might be a nefarious manager, or that the building developer had actually had a string of defects in past life. So there's a lot that needs to be done in the due diligence. And I think something I always say, it's good to learn a lesson once. You don't want to learn it again. So when you're looking at a fund manager, actually looking at fund managers who have managed difficult situations, who've been through the cycle, that's really important because it's not all sunny days. Angelo, I'd like to turn to you now. You've been recently vocal about the murkiness of transparency in private credit. What do investors need to be looking out for?
Look, I think private credit has expanded enormously over the last 5 or 6 years, and there are lots of players who are out with capital. And I think there will be pressure to deploy that capital. So I think investors have got to be a bit careful because most of the lending is in the development sphere. In my experience of investing in development and running development projects, which we don't do now, is that everything takes longer, everything costs more. And we've seen that in the last 3 or 4 years where, a lot of builders have struggled to survive. So obviously there are a lot of talented private credit groups that are experienced enough to see through a lot of that. But I think, when you're investing in non-stable assets, there's always a bit of risk and that's got to be managed carefully.
Absolutely. Now, Andrew, you've mentioned that Vest is focused on stability and you're careful not to stretch for the yield. A similar question to I asked before, but what makes you say no to a deal?
We say no to a deal where preservation of capital is at risk. We're just very clear on that. We've solved this problem with technology. So we've built our own investment platform from scratch. And the reason we did that was so when we put up a deal for investors to look at, they can either take the deal or not take the deal. Now, when they invest in that particular loan, or the loan runs its course and then it repays, we return capital to investors. So this gives us the flexibility, which is quite different, I think, to the rest of the market, where we don't have a pool of capital that we always have to have out the door. If a deal's a bad deal, we just won't do it. And then if a deal pays off, we pay the money back. And so that flexibility of being able to put deals out to investors, raise the capital and return a really efficient way through our investment platform is a real differentiator. And I think gives investors the confidence that we're not just doing deals for doing deals' sake, just because we have to move the money. We just won't do the deal. And I think it's been a common theme across the panel as well that obviously we're co-invested on deals as well as a first loss piece with investors. And I think that really putting your money where your mouth is so important.
Absolutely. I know we say no to about 95% of what we see, which I guess makes my daughter right that I do always say no. Now, I want to turn to the outlook. We've had, private credit in particular has had about a 15% CAGR growth in the last 5 years in Australia. It has gone from niche to the mainstream. The Australian property market also has been incredibly resilient through a very turbulent time of affordability crises and high interest rates. But it's held strong, but returns are not what they were of the past decades. So I want to now focus a bit on the outlook. How do we keep this sector healthy, credible, investable, while managing new headwinds? Anton, I'll start with you. Responsible lending is under the microscope. How do you stay ahead of regulatory scrutiny and what do you do?
Yep. I think there's probably going to be 2 points that hit home for that is private credit is going to get more managed and sort of scrutinised from a valuation perspective. So as investors, they're going to sort of get a bit more insight into that. We are not that, so we sort of don't have too many investors, and if we do, they're sort of equity. So what we obviously lend money out, and we don't lend it on a consumer basis. So sort of the regulation for us is almost doesn't exist. It does, but it's very, very small, and so business to business. And a lot of the effort from a government is focused on protecting the consumer and protecting sort of the non-wholesale network. Well, that's great if you're buying iPhones and things like that and you're taking some debt out for that. And I think that's very important. But, we're lending money to a market where, it's also, it's an asset and revenue generating asset. So, they're buying some fertilizer at the end of a season. They're going to put $10,000 or $50,000 of fertilizer on a crop. And they're looking at sort of 2 month turnaround with a bit of rain. They're going to generate 40, 50, 60% yields overall. So that small amount of money that we put in is going to multiply by about 6. So yes, regulation's important, but it's also sort of relevant to the outcome. And so for us, we're obviously not going to put money into things we're not going to money back on. And I think, from a regulatory point of view, that's just as important. We do all of our ACL training. We sort of lodge everything we need to. Separately to DelayPay, we invested in a business called Financial Education Professionals. So we provide all the AFSL training and ACL training to probably some of you guys. And so, hopefully we're across that well enough. But I just don't see it being a big influence in sort of business to business lending soon.
Well, you certainly sound like you've got the right amount of skills. I'll be very interested to hear your story later. I think just to touch on there, one of the really important things in all private credit lending is the valuation. That's what you're basing your LVR on, the level of equity buffer that you have. If there's not an independent, verified, good quality valuation, that could mean very little. So that is certainly something to look on in your due diligence. Daniel, you've been across a lot of spectrums, invested in debt, invested in equity. What's your view on the outlook for the sector and your one piece of advice you'd like to leave people with today?
Well, I think the outlook for the sector is positive. I think it's a sector that's here to stay. It's a sector that's growing. Clearly, investors like it. Clearly, borrowers like it. The regulators have a responsibility to make it safe, largely for the retail market, and we all welcome that. So I think the future for private credit across the spectrum, be it real estate, corporate, asset-backed lending, and otherwise, is bright, and it makes sense to have it in a portfolio. In terms of advice for an investor, I kind of think of, I would say to someone, well, if roles were reversed, what's the best question that you could ask me? Like, what do you know that I don't know that I should know? And it's, how do I lose money on this deal? How does it compare to the last 3 or 4 deals that you did? Tell me about the time you lost money or almost lost money, and what did you learn from that, and what are you doing differently? That's what I would be asking if I was interested in investing in this sector.
I think that's fantastic. That's a really great takeaway. Campbell, you've been across big policy decisions, infrastructure development, fund management now, being the former Queensland Premier, Lord Mayor, and a big career across the army and infrastructure. So I think you've got a lot of experience and exposure. We're going to see a lot of change in the macroeconomic environment this year, and already have. Interest rates look like they're going down. Interested in your view on commercial property, how you think that's going to change dynamics over the next 1 to 3 years.
Well, I think the lower interest rate environment's going to sort of see the compression of yields pick up again. Retail, it's happening now. Industrial is massively overpriced. Office has been an opportunity, and the yields didn't soften when when interest rates went up to the same degree. So stuff's quite expensive. I'd like to have a real go though back on this on private credit and regulation. Don't be so nice about it. Anyone from ASIC here? Well, it won't stop me. There's a real problem with our regulators in this country, ladies and gentlemen. AUSTRAC, APRA, ASIC, they need to be brought under control by the political class, but it's clearly not going to happen after the election we've just had. The reason that private credit has exploded is that APRA dramatically tightened the lending standards on the banks. They moved out of the higher risk lending, which meant that property development couldn't get off the ground without private credit. And now that private credit is funding it, now our regulators, bless their cotton socks, are looking over there going, ooh, what's happening over there? And they will hurt it. They almost damaged it last year by changing the definition of a wholesale investor, which would have been devastating to private credit. It also would have been devastating to what we do. It would have been devastating to start-up tech companies, biotech, etc. So, ladies and gentlemen, if I've got a message today, when you see this stuff in the AFR or the Australian, you need to pick up your phone or get on the keyboard. You need to go to your local, probably your local Labor member, and actually tell them why it's bad. We can't engineer out risk through regulation. Regulators should be going after dishonest, shonky people, incompetent people, but at the end of the day, you can't regulate out business failure. It's just never going to work. That's what concerns me at the moment. My final salvo is this unrealised gain thing is this most diabolical proposal. It's not about higher tax on super. It is about upending the principles of the tax system in Australia, and somehow this has to be headed off before it becomes black letter law in the coming weeks.
I knew you'd have a lot
Couldn't
to
agree
say.
more.
Hear, hear. think at one of the last conferences, Steve joked that the role of the AFR in private credit was to build it up and then tear it down. I think we've only got a few more minutes, so I need to wrap up. So I might just ask Angelo if you've got any final words, and then over to Andrew if you've got any final words before we wrap up this panel.
No, look, I think Campbell summed it up pretty well, and I'm 100% supportive of what he just talked about. I think in commercial property, we're probably, for owners, it's probably going to be a good time with interest rates dropping. For new opportunities, it's going to get harder, and we've found that as we're looking for our new opportunity, certainly yields are starting to tighten. So we need to be more cautious going forward and making sure that the right opportunities are presented.
Great. And Andrew?
Thank you. I might make a couple of points, if you'll indulge me. The first is one of the things that ASIC's looking at in private credit on the investor side is transparency on valuations. Since day one, we've actually shared the independent valuation reports on every single deal with all of our investors. Very simple. It's quite, that's what we're leaning against. Why wouldn't we share it? So that's a very clear-cut way to deal with that. The second thing is on the Division 296, the unrealised capital gains tax on SMSFs, on super funds rather. Our modelling shows that on an SMSF balance of opening balance of $5 million, generating a 10% net return to the SMSF, that super fund would have to generate about a 6.2% cash yield to cover the pension to somebody between the age of 65 and 74, as well as the Division 296. Now, if you look at corporate bonds, a diversified listed corporate bond ETF, investment grade is paying about 5.5%. Government bonds, 2 years, is paying about 3.5%. The yield on the ASIC 200 is about 3.7%. The S&P 500, forget about it. So where do you go? How do you generate 6.2% on investment grade investments in Australia for an SMSF with a balance of $5 million? And so private credit is a fundamental part of a portfolio, I believe, for super fund investors and investors in Australia more broadly.
I'm getting the look, so I've done a terrible job of keeping to time, but I would say that this has been an excellent discussion, so I thank you all.
Thanks, Brad.